It's similar to learning to ride a bike to learn about investment. It may appear frightening or confusing at first, and risks appear to be everywhere. For this reason, it's necessary to master the fundamentals of how to reduce risk and protect yourself. You may remove the training wheels and begin riding seriously if you've had a lot of experience and learning. The routes may vary along the journey. There are good days and terrible days, and although riding a bike won't gain you a place in the Tour de France, it could help you get there a bit quicker. Start with the fundamentals and examine one of the most popular investments. When you buy a stock, you're purchasing a piece of a business called a share. By holding a share, you have a claim on the company's future earnings, as well as a tiny portion of its assets. There are two methods to profit from stock investments. The first is through stock appreciation, which occurs when the value of a stock you hold increases. For example, if an investor purchased a stock at one price and it increased in value, the investor may profit by selling the shares to another investor at the higher price. The second method uses a dividend, a regular payment made by select equities. A company can distribute a portion of its profits to shareholders in the form of a dividend. Here is an illustration of how stocks function. Assume there is a Cycle Corporation. This firm manufactures extremely excellent bicycles. In fact, the company wants to grow so that it may sell more bicycles to customers all over the world. To achieve this, the business must raise cash, commonly known as capital. There are several methods for the business to do this, including taking out a loan, which would entail taking on a sizable amount of debt, or issuing stock. By selling shares of ownership and a claim on future revenues to investors, a process known as going public, a firm can obtain capital without taking on debt. Let me know in the comments if you have any other questions about investing. Let's return to the video. So let's get to know a common investor. This person is someone who has some spare money. He is prepared to take on the increased risks associated with investing in stocks in exchange for an investment that has the potential to provide larger returns than a savings account. He believes that the Cycling Corporation is a promising business with room to develop, and that purchasing shares would be a wise investment. So what is the price of a share? Consider a scenario in which the business decides to fund $2.5 million by issuing 10,000 shares of stock, each of which represents a little portion of the overall value of the business. There are 10,000 shares, and as the firm is seeking to raise $2,500,000 through the IPO, each share will initially be worth $250. Assuming that the price remains the same following the IPO, our investor pays $250 per share on the open market using this online stock broker. Let's now analyze the potential outcomes for his investment. The worth of the corporation is expected to rise as a consequence of increased earnings, and as a result, the stock price may rise. Our investor may now make money by selling his shares with another investor on the stock market if the stock price increases. However, if the business initiatives don't turn out as expected, the company's worth might decline, and so could the stock price. If this occurs, our investor could lose money if he chooses to sell at the current price. The basic principle of investing in the stock market is to purchase when prices are low and sell when prices are high. But prices don't always rise for stocks. Sometimes they stay the same, other times they fall, and other times they fluctuate fast. As a result, stocks are viewed as riskier than historically safer assets like bonds or CDs. Investors continue to return to the stock market because with more risk comes the possibility for higher profits. Unfortunately, investors take measures to attempt to reduce risk, such as developing an investment strategy, diversifying their portfolios by investing in a range of firms, placing cash and other assets alongside stocks, and learning trading tactics for up, down, and sideways markets. You now have a basic understanding of stock investment, but that is only the start. Hope you have learned something from this video. What are your thoughts? Comment down below. If you enjoyed this video, make sure to click the like button and also don't forget to subscribe to the channel and hit the notification bell for you to be updated on our latest videos. See you in the next video. Thanks for watching! Want to learn more and be more financially literate? Click on the next videos we have in our channel, showing on the screen right now.